Welcome to this comprehensive exploration of the balance sheet, a cornerstone of financial reporting. Understanding this fundamental statement is crucial for anyone seeking to grasp the financial health of an organization. It provides a static snapshot, a precise picture of a company's financial position at a very specific moment in time. The balance sheet serves as a vital tool for assessing what a company owns, what it owes, and the value remaining for its owners. Unlike other financial statements that cover a period, the balance sheet captures data on a particular date, offering a clear point-in-time reference. This unique characteristic makes it indispensable for financial analysis and decision-making. At the heart of every balance sheet lies the fundamental accounting equation: assets equals liabilities plus equity. This equation is not merely a formula, it represents the core principle of double-entry accounting and the very structure of a company's finances. It dictates that everything a company owns must be financed either by borrowing or by the owner's investment. This equation ensures that the balance sheet always remains in balance, reflecting the dual nature of every financial transaction. It illustrates that a company's resources, its assets, are always equal to the claims against those resources, which are its liabilities and equity. This equilibrium is non-negotiable in financial accounting. Assets represent everything of value that a company owns or controls. These are resources expected to provide future economic benefits to the business. Assets can range from physical items like buildings and machinery to non-physical items like patents and cash. Liabilities, on the other hand, represent what a company owes to external parties. These are obligations that must be settled in the future, typically through the transfer of economic benefits. Common examples include money owed to suppliers, banks, or employees. Equity, often referred to as owner's equity or shareholders' equity, represents the residual value of the company. It is the portion of the assets that belongs to the owners after all liabilities have been satisfied. Equity reflects the owner's stake and their investment in the business. Assets are the economic resources controlled by a company as a result of past transactions or events. They are expected to provide future economic benefits that contribute to the company's operations and profitability. The classification of assets on the balance sheet is primarily based on their liquidity. Liquidity refers to the ease and speed with which an asset can be converted into cash without significant loss of value. This categorization helps users understand a company's ability to meet its short-term obligations. Assets are broadly divided into current assets and non-current assets. Current assets are those resources that are expected to be converted into cash, sold, or consumed within 1 year or within the company's normal operating cycle, whichever is longer. These assets are crucial for a company's day-to-day operations and short-term financial health. Cash is the most liquid of all assets, representing immediate purchasing power. It includes physical currency, bank deposits, and other cash equivalents readily available for use. Cash is fundamental for covering immediate expenses and obligations. Accounts receivable represents money owed to the company by its customers for goods or services already delivered but not yet paid for. This is a significant current asset for many businesses, reflecting sales made on credit. Effective management of accounts receivable is vital for cash flow. Inventory includes raw materials, work in progress, and finished goods held for sale in the ordinary course of business. It is a current asset because it is expected to be sold and converted into cash within the operating cycle. Managing inventory levels efficiently is key to profitability. Short-term investments are financial assets that can be easily converted to cash within 1 year. These are typically held for a temporary period to generate returns on excess cash. Examples include marketable securities like stocks and bonds that can be quickly sold. Non-current assets, also known as long-term assets, are those assets that are not expected to be converted into cash or consumed within 1 year. These assets are typically held for long-term use in the business operations and contribute to future economic benefits over an extended period. Property, plant, and equipment, often abbreviated as PP&E, are tangible non-current assets used in the production of goods or services. This category includes land, buildings, machinery, and vehicles. These assets are typically depreciated over their useful lives, reflecting their consumption over time. Intangible assets are non-physical assets that have economic value because of the rights they confer to the owner. Examples include patents, trademarks, copyrights, and brand recognition. These assets often represent significant value, though they lack physical form. Long-term investments are financial assets held for more than 1 year, typically for strategic purposes or long-term growth. These might include investments in other companies' stocks or bonds that are not intended for quick sale. They contribute to the company's financial strength over time. Liabilities represent a company's financial obligations to external parties, arising from past transactions or events. These obligations require the company to transfer economic benefits to other entities in the future. The classification of liabilities is primarily based on their maturity date. Maturity date refers to the date on which a liability is due to be paid or settled. This categorization helps users understand a company's short-term and long-term financial commitments. Liabilities are broadly divided into current liabilities and non-current liabilities. Current liabilities are obligations that are expected to be settled within 1 year or within the company's normal operating cycle, whichever is longer. These liabilities are crucial for assessing a company's immediate financial obligations and its ability to meet them. Accounts payable represents money owed by the company to its suppliers for goods or services purchased on credit. This is a common current liability, reflecting the normal course of business operations. Managing accounts payable efficiently is important for maintaining supplier relationships. Salaries payable refers to the wages and salaries owed to employees for work performed but not yet paid. This is a short-term obligation that typically needs to be settled within a few days or weeks. It reflects accrued expenses that are due. Short-term debt includes loans or other borrowings that are due to be repaid within 1 year. This can include lines of credit or the current portion of long-term debt. These obligations require prompt attention to avoid financial distress. Non-current liabilities, also known as long-term liabilities, are obligations that are not expected to be settled within 1 year. These liabilities represent a company's long-term financial commitments and often involve significant amounts. They are crucial for assessing a company's long-term solvency. Long-term debt includes loans, bonds, or other borrowings that are due to be repaid in more than 1 year. This type of financing is often used for major investments like property, plant, and equipment. It represents a significant long-term commitment. Deferred tax liabilities arise when a company pays less income tax in the current period than it will owe in the future. This often results from differences in accounting methods used for financial reporting versus tax reporting. It is a future tax obligation. Pension obligations represent a company's commitment to pay retirement benefits to its employees. These are long-term liabilities that can be substantial, requiring careful management and funding. They reflect promises made to employees for their service. Equity represents the owner's residual claim on the assets of the company after all liabilities have been deducted. It is the net worth of the business from the owner's perspective. Equity reflects the capital contributed by owners and the accumulated profits retained within the business. The nature of equity is residual, meaning it is what's left over for the owners once all other claims have been satisfied. This makes equity a crucial indicator of a company's financial strength and the value created for its shareholders. It is a measure of ownership. Common stock represents the initial investment made by shareholders in exchange for ownership shares in the company. This is the par value of the shares issued. It signifies the foundational capital contributed by the owners. Retained earnings are the accumulated net profits of the company that have not been distributed to shareholders as dividends. These earnings are reinvested back into the business to fund growth, pay down debt, or acquire new assets. They represent a significant source of internal financing. Additional paid-in capital, also known as capital surplus, is the amount shareholders paid for their stock above its par value. This reflects the premium investors were willing to pay for the company's shares. It is another component of the capital contributed by owners. Analyzing the balance sheet is essential for assessing a company's financial health, stability, and potential for future growth. It provides critical insights for various stakeholders, enabling them to make informed decisions. The balance sheet is not just a report, it is a diagnostic tool. Several key metrics and ratios are derived from the balance sheet to evaluate different aspects of a company's financial standing. These ratios allow for comparisons over time and against industry benchmarks, providing context to the raw numbers. They transform data into actionable intelligence. Liquidity ratios measure a company's ability to meet its short-term obligations. The current ratio, calculated as current assets divided by current liabilities, indicates the extent to which current assets cover current debts. A higher ratio generally suggests better short-term financial health. The quick ratio, also known as the acid test ratio, is a more conservative measure of liquidity. It excludes inventory from current assets, as inventory can be less liquid than other current assets. This ratio provides a stricter view of immediate solvency. Solvency ratios measure a company's ability to meet its long-term obligations. The debt-to-equity ratio, for instance, compares total debt to total equity. A lower ratio generally indicates less reliance on debt financing and a stronger financial structure. Asset turnover ratios measure how efficiently a company is using its assets to generate revenue. While often involving the income statement, the balance sheet provides the asset figures. These ratios indicate operational efficiency and asset utilization. The balance sheet is vital for a wide range of stakeholders. Investors use it to evaluate a company's financial strength and risk before making investment decisions. Creditors, such as banks, rely on it to assess a company's ability to repay loans. Management uses the balance sheet to monitor financial performance, make strategic decisions, and manage resources effectively. It helps them understand the company's capital structure and identify areas for improvement. Regulatory bodies also use it for compliance. In conclusion, the balance sheet is an indispensable financial statement that offers a critical snapshot of a company's financial position at a specific point in time. By understanding its components, assets, liabilities, and equity, and the fundamental accounting equation, one can gain valuable insights into a company's financial health, risk profile, and overall performance. It is a crucial tool for making informed decisions about a company's future.